everyone, and good morning from New York. My name is Eric Lund, and I'm a senior economist here at the Conference Board. And welcome to our monthly Economy Watch. This month, we are going to, in addition to reviewing our monthly economic outlook, we're going to spend some time exploring some of the key findings from our latest C-Suite Challenge Report. These questions include what's top of mind for CEOs for the coming year. How do executives see the evolving challenges of data privacy and cybersecurity, and why C-suite executives are concerned about increasing competition in the global marketplace. I should also mention that this webcast does qualify you for CPE credit, so make sure to sign up for that if you're interested. Today, I'm joined by a couple of our greatest minds here at the Conference Board. Ilaria Maselli is the senior economist for Europe. Ilaria, do you want to say hello?
Hello, everybody. Happy New Year, and thank you for having me on the first Economy Watch of the year.
And Chuck Mitchell, the Executive Director of Knowledge, Content, and Quality. Hi, Chuck.
Hey, Eric, how are you? And Ilaria, good day.
Yeah. So we're going to start off today by quickly reviewing our global European and U.S. economic outlook. But before we dive into the numbers, Chuck is going to walk us through a couple of insights from the C-Suite Challenge that are really applicable to this economic outlook.
Yeah, so indeed, so from this year's survey, just for a quick overview, we're going to look at the external stressors that CEOs are feeling globally. And top of the list is of recession risk or fear of recession, concerns about global trade, concerns about tighter labor markets, global political uncertainty, obviously a hot topic in recent days, and this notion about a more intense competition, right? Which we're feeling, which CEOs say that they're feeling not only from startups and new technology companies, but just from this whole notion of digital transformation throughout. So those are going to be the highlights that we'll see, and we'll do a regional breakdown on those two later on. But just to address the notion of recession risk, I guess one of the fears, and I guess what we're going to hear later, is that recession is not imminent. And one of the dangers here that recession becomes a self-fulfilling prophecy in the eyes of CEOs and their actions. We're already starting to see some of the responses in the survey reflect a concern about cost controls and investment. So when you start to look at fear of recession and couple that with the actions, it goes from theory to reality, and that's one of the dangers. Interesting though, it's the second year in a row that recession has been top of the list. 2 years ago, it was near the bottom. It was 19th. So that pressure, that psychology is starting to really surface in the business view.
Sure. Well, I mean, I know certainly earlier this year, really around the summer, there was a lot of talk about recession and concern about it, especially in the media. But our outlook at the Conference Board is a little more positive than that. We don't expect to see a recession anytime soon. For a brief overview of what we see for 2020, you can see some of the numbers that are presented in the slide. For the global economy, 2020, we do expect to see a modest improvement, actually, in global growth, as opposed to any sort of deterioration. But most of that is going to be driven by emerging markets. Those are going to be the economies that primarily tick the needle up a little bit for the global economy. There are a couple of assumptions that are associated with this. We do expect a global industrial down cycle that we've been seeing in 2019 to really play out. And manufacturing and industries like that to actually improve a little bit over the coming year. Some of the trade hostilities that we've been seeing in 2019, especially the U.S.-China trade dispute, we expect that to cool off a little bit over the next couple of months as well. Business confidence, as a function of some of these factors, should improve a little bit in 2020. Which will, of course, help with things like capital spending and investment. And emerging markets, again, should improve a little bit. But why don't we go ahead and conduct a quick poll that we've prepared for everyone before we move on. Can we get that poll exercise up, please? I mentioned earlier on global manufacturing and some of the difficulties that we've been seeing within that sort of sector of the economy in 2019, and we're wondering what you think about is ahead for 2020. So global manufacturing, as I mentioned, went through a severe downturn in 2019. In 2020, do you expect manufacturing to continue to decline, recover to some extent, or to grow more strongly? Let's give you another second or two to lock in your answers. And let's close that poll. Interesting. So we have about 75% of the audience voting recover to some extent, 25% continuing to decline, and 0 are predicting any sort of a stark increase. That's, I think, somewhat in line with our view, although I think maybe we're not as pessimistic maybe as a quarter view. Ilaria, do you have any comments on the results of this poll?
Yes, my comment is I'm relieved because, well, we also expect the downturn to recover to some extent. We expect on that ground 2020 to be better than 2018. So I'm happy to see that 74% of the audience agree with this perspective, and which is in a way less in line with the results of C-Suite Challenge, but that seem to me much more pessimistic than what we see right now. And the continued declining, well, if I had to choose between the two extremes of growing strongly or continue declining, I would also lean towards a more pessimistic view of manufacturing. So I guess nobody expects to see manufacturing growing strongly, but I think it's a safe prediction to say that it should recover to some extent.
Chuck, anything to add?
Yeah, I think that it looks to be a bit of a cautious optimism recovering to some extent. And again, I think when we go back to see where the CEOs are in their head and their concern about recession, it's not a total complete collapse, but I think it's that cautious optimism and that cautious attitude towards spending and growth. So yeah, it seems to fit.
Okay. Well, I was hoping maybe for some. I'm an optimistic guy, so I like to hear audiences chime in really strongly on some things. So we didn't get any of that, but that's okay.
Maybe we can change some minds on the
maybe
outlook.
Maybe we will, maybe we won't. But let's see here. This is sort of where we've been globally within manufacturing. What we're looking at now are, of course, a series of manufacturing PMIs from some of the major economies around the world. And really, maybe your optimism or your pessimism is really going to be driven by sort of where you're sitting at the moment. If you're sitting, for instance, in Germany or the Euro area, where the PMIs in manufacturing continue to be fairly weak, I can understand the pessimism. But really, for China, for ASEAN, for Japan, and the U.S., we've seen some stability in the numbers. A number of them still are below that critical 50 threshold, but numbers have increased above 50 as well. So we're really thinking that this year we'll start to see these tip up a little bit. One of the reasons that the decline occurred to begin with, and we wrote about this a little bit in our Global Economic Outlook, was really centered in China. We had a fairly sizable amount of overcapacity in heavy industries in China that had really been an issue for that economy for over a decade or so. And a lot of work was done to sort of reduce that overcapacity. It's called the supply side structural reform, is the name that the Chinese government gave it. And as a function of that, there was a down cycle within those heavy industries in China that eventually sort of propagated downstream into other manufacturing industries in that country. China, of course, being the largest manufacturer in the world, this downturn propagated overseas and started to affect other economies as well. The positive of all this, again, that optimism that I love so much, is that the overcapacity in China has improved. There's still a fair amount there, but some improvement has been made within that sector. And that we now expect a healthier manufacturing economy in China that will eventually, again, propagate overseas as well. One thing that we want to talk about a little bit more, I think, is the perspective from Europe, and Ilaria is going to tackle that for us now.
Happy to do that, Eric. I think the previous slide is actually a very good starting point, because if you look at the different colors on that chart, you will immediately notice the green one, which is Germany, where this upturn until 2016, 2017, and then the downturn has been really extreme. I mean, it was on the top at the beginning of 2018, and then you can see it's at the very bottom right now. So the German manufacturing, which is the engine of the European manufacturing, has been suffering a lot in a sort of mirror image of what happened before, when global trade was growing stronger in 2016 and 2017. So we need to keep, I would say, the overall cycle in mind when we talk about this. Now, if you look at the euro area, last bit of the PMI, you can see that there is some sort of stabilization that seems to be happening, and that's one reason to be moderately optimistic, as you said, and look at the recovery during this year. So this is the reason why, basically, at the end of the day, we don't think that a recession is imminent in Europe either. Now, I'm going to take a couple of minutes to explain this chart, because it's as important as complicated for us and for our analysis. So just give me 2 minutes to explain this one. So what you see in the blue line there is the 6 months growth rate of the LEI, of the Leading Economic Index for the euro area. Now, you can definitely see that the LEI has been declining since February 2018, and it has been going down. Not that fast, but still, you definitely notice it there at the end of the line. Now, the other important line is the red line. So the red line, or the red dots here and there, appear whenever the LEI is in negative territory, and more than half of its 8 components are contributing to that negative performance. So this means that basically the stress in the economy is widespread across different sectors. And so basically, if we look at the last months or the last couple of years at the end, what we see is that the manufacturing part of the economy is definitely going through a lot of stress, but not much is happening on the other side. And this is why the red dots are not popping up there. That's really because the stress in the economy is confined to the external demand, to the external part of the economy, for all the reasons that you just mentioned, whereas domestic demand is in pretty good shape. So, as I said, this is the background. This is why we don't expect a recession in the euro area either. Even though, of course, we're not talking about fantastic growth number. What we predict for 2020 is 1.3%, which is a little bit better than the 1.2% of 2019. So more or less a prolongation of the trend of the last year. Now, one thing to keep an eye on is definitely the labor market. So the story is basically that, if you go to the next slide, another chart there that I would like to show. So the story is that we need to really keep a close eye to what happens to domestic demand and to consumer confidence, because as long as consumers remain optimistic and as long as the labor market is adding jobs, Europe can continue to grow, basically thanks to its domestic demand. And so this is what has been happening in 2019, and this is also what hopefully happens in 2020. With hopefully an uptick coming from the manufacturing sector as well. What you see on the chart here is the labor market, which is the key for this. So what I put on the chart there is the employment growth year on year. And as you can see, it is the labor market is still adding jobs. It started to do so in the last 4 quarters a little bit more slowly, but we still have a year-on-year job creation of 1%, which is remarkable, especially considering the slow growth rates that we face in Europe. And the other super interesting thing, in my view, is the fact that there is more people in employment today than there were at the beginning of the global financial crisis a decade ago. So we have about 160 million people in employment today, and this is more or less 10 million more than 10 years ago. So that's, I think, an impressive number. So if you are a consumer or a worker in Europe, in the euro area right now, you see a fairly favorable situation in the sense that you have still a strong labor market. Wage growth is higher than inflation, so the purchasing power of households is increasing. So all in all, is not a bad situation, and that justifies the fact that consumer confidence is high. But of course, we need to keep a close eye on this, because the moment consumer gets a contagion of pessimism from CEOs, then that's when we need to get worried.
Now, Ilaria, before I let you go, I can't help myself but ask a little bit about Brexit and what your thoughts are on what's happening in the UK at the moment.
We don't want to talk about Brexit anymore in Brussels. That's a difficult subject. No, jokes aside. No, what I wanted to say is that, first of all, we expect the economy to weaken in the UK. We actually expected the UK to go through a recession right now, but we revised our estimates a little bit upward, but we still expect 2020 to be not as good as 2019. So we had growth in the UK in 2019 of 1.3%, and we expect in 2020 1.1%. Now, one thing everyone knows that 31st of January, 11 p.m. UK time, UK will leave the EU, and this is fairly sure, I would say right now. You never know, because every time there's been a date that's been postponed in the past, but I think right now it's a sort of a safe bet, but not a lot will change during this year. So the biggest changes will actually happen at the end of the year, when there is the end of the transition period, because after the transition period, then there will be a completely new relationship that is defined by a trade deal that still has to be written. So this is where there is a lot of uncertainty of what that trade deal will look like, and a lot of people are skeptical that there will be at all a trade deal, because it's very difficult to negotiate one in such a short time.
Well, I'm going to quote you in a few weeks and see whether or not you're right in terms of what happens. Such a volatile story. But thank you so much for your insights there. That was really helpful. Let's quickly go over our outlook for the U.S., and then we'll go ahead and dive into the C-suite challenge portion of the presentation. So we have some improved news from our most recent U.S. leading economic indicator. The reading for November, actually, on a month-to-month basis, was relatively stable after having been weaker for 3 months in a row. When you blend all this together and look at this using a 6-month moving average, the LEI is still a little bit negative, but certainly the trend and the direction it's heading in, this sort of increasingly sideways direction, is really consistent with the kind of stable sort of sideways U.S. growth that we're expecting for 2020. In terms of the individual quarters, we're expecting the fourth quarter of this year, of last year, of 2019, to clock in at about 2.2%, which is a slight uptick from the third quarter. And that will translate to a 2019 annual growth rate of about 2.3%. Now, this 2.3% is a lot lower than the 2.9% growth that we saw in 2018. And we expect growth for the coming year, 2020, to come in at about 2.1. So again, a little bit slower, 2020 versus 2019. But if you look at the chart, if you look at this on a quarterly basis, you can see that a lot of that slowdown has already sort of made its way through the system. And that quarter 1, 2, 3, and 4 for this year, we're looking at more stable growth more than anything else. Of course, the sort of composition of this growth is going to change for 2020. The growth story in 2019 had a lot to do with a really strong U.S. consumer. We expect the U.S. consumer to continue to do well in 2020, but maybe just not as well as they did last year. So a continued contribution from consumers this year, but at a slightly lower sort of a rate over the next several quarters. So that, you would think, would lead to a slowdown in overall GDP. But that's not the case because we think that we're going to see business investment start to tick up. As I mentioned, the trade disputes that we've been seeing in 2019 that really weighed on, I think, businesses seem to be settling a little bit. Hopefully, we have a phase one trade deal between the U.S. and China signed later this month. And then again, this sort of industrial cycle, the down cycle that we've been grappling with over the last month, we think that that's going to stabilize and start to improve as well. So these two factors, I think, we're really going to help to drive business investment up a little bit into 2020. Also, something interesting that we've noted is U.S. housing starts and authorizations have really been jumping really since the summer of 2019. So much so that the rates that we're seeing in terms of starts and authorizations are as high as they've been since 2007. So really some activity there. And that's translated into stronger residential investment numbers that we saw in third quarter 2019 GDP numbers. So we're expecting that housing story to continue through 2020, and some support will be offered to overall GDP from the housing sector as well. So you can see this is the story for consumption in the U.S. over the last several years. We've already seen a little bit of a slowdown throughout 2019. The most recent numbers in November were up a little bit. We think that we're still going to have fairly strong holiday spending that we've just gone through. But again, this line is not going to drop significantly or precipitously. It's nothing to be alarmed about, but we do expect it to slow gradually. And that is in many ways a function of slower growth rates seen in personal income. The labor market in 2019 was very tight. We saw a lot of growth in income, especially blue-collar workers. For 2020, the labor market, we think it's going to remain tight, but just not as tight as it was last year. And so that's going to, again, result in a slight moderation in income growth and a slight moderation in consumption growth as well. Business confidence and capital spending, I mentioned this briefly. If you look at our CEO confidence index, CEO confidence in the U.S. has really dropped pretty significantly in 2019. And the associated non-residential fixed investment, or business investment, if you will, has dropped as well. But again, we think that this confidence is going to increase a little bit. Maybe Chuck and Ilaria will disagree with me a little bit based upon the research findings that they've just published. But we do expect this to turn around a little bit over the next several quarters. And just to give you a visual sense of the starts and authorizations and housing that I mentioned, you can see that really since the summer, we've seen this massive uptick in these numbers. And we expect that we're going to really see a strong housing market in terms of construction activity, things like that in 2020. We're actually dedicating next month's webcast to this topic. So we'll explore it in more depth, and we'll get some other individuals to come in and share their thoughts on it with us as well. So here are the individual numbers for our most recent U.S. forecast. We're not going to go into them in any detail, but if you'd like to, you can make sure to download this presentation, and you can reference them after the webcast is finished. So we've already taken up a fair amount of time talking about the economic outlook. We're going to cut that off now. And I want to hand it over to Chuck and Ilaria now to talk about the C-Suite Challenge.
All right, let me start, or maybe actually, Eric, you start, because we start with
No, actually, I think we're going to just quickly give a little overview here of what the C-Suite Challenge is, okay, and how it's done, correct?
Yes, correct. So this is actually a very long-term project of the Conference Board. It's in its 20th year, and we run the survey normally, like we did this year, between September and October. And we got about 1,500 replies among C-suite executives, of which half, 740, were replies from CEOs. And we did it slightly different this year because we explored a very specific topic. It was a bit of a bet, but I think we got it right in the sense that we decided to explore a very strategic topic, which is collaborating to compete is the big title. So how companies are reacting to competition by creating new forms of more or less adventurous partnerships. And we're going to tell you more about this. But we also have some recurrent questions, like every year we always have the hot button. This is actually what we're going to discuss today. So you will have to invite us again to discuss the second report in a month or so. We don't do this on our own. We coordinate this project when we get help from 14 institutes around the world that help us circulating the survey to their members, to the companies that they are in touch with. And that's how we get such a high response rate, of which we are very proud.
Okay, so let's jump into that poll question now. Can we get the poll up, please, in the studio? So global CEOs do not consider the following items below to be hot button issues. Among these, which one do you think is the greatest concern for businesses in 2020? Tax policy, energy prices, terrorism, income inequality, data privacy, gender pay gap, labor regulations, and health care benefits. And then I believe we're going to compare what you say to what some of our CEOs said as well. So there's a lot of options. I'll give you just a few more seconds to try to find your favorite. And let's go ahead and lock that in if we can. So it looks like data privacy, with about a third of the respondents, came in at number 1, followed by tax policy at about 15%, and labor regulation and healthcare benefits also tied, and then income inequality followed by energy prices. Terrorism was near the bottom, and gender pay gap finished dead last. Oh, that's not a great sign.
No, but it tracks the overall responses from our poll. So indeed, that raises a red flag for us. It's a cause for concern, especially when as you're starting to see more pressure on reporting gender pay differences and demands not only from investors but from the regulatory side too. So it's probably something that's going to need more attention on behalf of CEOs in the future for sure.
Ilaria, any comments?
Yes, a couple. One is on energy prices. I was expecting, given the tensions in the Middle East and the possibility of oil prices increasing because of the tension, I would have thought this would get more attention, at least in the audience today. We circulated the poll in September and October, so that was less 10 times, and so that's why it doesn't rank very high. But at least today, I thought I was going to see that. Higher on the list. Another one that we raised also as a flag is inequality. That probably doesn't get as much attention as it should, because it can have large implications for businesses as well. So yes, it's a pity that it doesn't rank that high. And then I guess the audience we have today is a bit biased towards the US, and that's why we get more attention for things like healthcare benefits, for example, which would be less of a concern for European audience, for example.
Interesting. Well, thanks for sharing, everyone. Why don't we maybe move into some of the material? Do you want to, Ilaria, do you want to talk a little bit about the next slide?
Yes, okay, so let me start. We have a lot of data, so it's never easy to start talking about this, but I will start with this. So this is a bit of a summary, like really big overview of the results. Maybe I should say first that we have 2 hot button questions, and one is basically what keeps you awake at night in the external environment, and the second one is what keeps you awake at night looking inside your company. So here in this table you have a list of both taken from both questions, and you have things that are ranking very high, and I will come to that in a second, and things that are ranking low, and that we thought, okay, this probably should get more attention than it did this year. So this is, I think, a very big overview. Now, if you go to the next slide, you will see that there are some things that are recurrent really everywhere in the world, and that's really the recession risk. If you look at China, US, Europe, I mean, everywhere, in every region, recession risk is either the top one or the top two risks. Then there are other things that are, I would say, fair and in line with expectations, and that's the concern around either trade and the trade tensions or the global political instability, which I would say are together, have to be seen together. And then the third issue that is recurrent, and that is where I think we got a good intuition of something that was happening behind the surface, is the concern about more intense competition. It was ranking much lower last year, and this year it's flagging there. The other thing that is interesting is tight labor markets. You can see it's number one in Japan, and like where else, of course, but it's also very high in the US, where indeed, I mean, when you reach unemployment rate of 4%, it becomes really difficult to recruit talent. So this also makes a lot of sense. And there are a couple of things there. I mean, the things at the top are interesting, but also the things that are not at the top perhaps are interesting to look at. One that is globally not so relevant, but is relevant in one region, is the effect of economic sanctions. And you can see that ranks number 5 in China and much lower elsewhere. I'm sure Chuck wants to add something on this, but before I let you do it, Chuck, I want to also flag the effect of Brexit, which confirms that no one wants to talk about Brexit anymore because it's ranking in Europe number 9. So it's probably because also you have the trade thing that's Brexit is part of that, and that's ranking very high for Europeans, is number 3. But not only that, it's been an issue for such a long time that really just the idea of finding one solution, whatever that is, it's already the light at the end of the tunnel.
No, and I think I think that notions about it, the effect of economic sanctions having such an impact or weighing so heavily on the minds of CEOs in China is an interesting riff off the notion of trade disruption as well. The trade disruption brings in the notion of tariffs, and tariffs are temporary. Tariffs come and go, right? Tariffs can go away in a day. But the notion of the sanctions is more permanent, right? It's the tech war, if you will, between the U.S. and China. Mm-hmm. It's a long-standing policy that at this point in time, there barring reforms, that there doesn't seem to be a lot of light at the end of the tunnel. And it's interesting that it's a real concern for CEOs in China, much more so than it is anywhere else globally. They're biting. Yeah, let's put it that way.
And I think that assessment is pretty consistent with the research that we've actually been producing at the Conference Board's China Center as well. This sort of trade tariff-oriented element of it is in one bucket, and that can be solved. But the structural technology issues that you were just talking about, those are longer term, and those are not ones that are going to disappear anytime soon.
Right. And it was interesting. I mean, it did surprise us that it popped up so high on the China in the China responses. Mm. So. It's certainly a red flag for anyone doing business there. It's a concern.
Sure.
If you go to the next slide, oh, there it is. I see it now. We also have different cuts of the data, and the one I showed you before was by region, but we can also look at it by different functions. And so this is what you see in this chart here, where we have the ranking of CEOs, and then next to it the ranking of CFOs and the ranking of human capital related executives. And well, that's always interesting to look at the different perceptions. If you look at the top, they're not very different between CEOs and CFOs. Human capital priorities are slightly different. But I want to highlight here, I have a lot of sympathy for the CFOs in this table, because there is a few things that really attracted my attention in the ranking of CFOs, which if you go below the top three, it's then very different from the others. So for example, they rank much higher cybersecurity. And if I remember well, and Chuck, correct me if I'm wrong, cybersecurity was the top #1 hot button issue in the US in the survey of last year, of 2018, and this year is a bit lower. But if you look at the functions, it's CFOs that are more concerned than other executives about this. So this is one interesting highlight. The second one is the impact of climate change on businesses among different functions. Is CFOs that rank that the highest, and I will come back to that later. So keep this in a place in your mind. I will come back to that. And then the other issue is currency volatility. A bit less surprising because I guess CFOs have to deal with that on a daily basis more than anyone else in a company. But that also is much higher than in the mind of CEOs and definitely human capital top executives. So I think there is always something in there that people in different functions are looking at different pieces, I would say, of the external environment. I don't know if Chuck, you want to add something.
Right. I mean, the notion the human capital executives are more concerned about tight labor markets. I mean, that's what they do. That's their job, right? Mm-hmm. And they're dealing with that on a daily basis. So that, that would come as no surprise. But, I also think that both on the CFO side and the human capital side, when you look at that notion of tougher regulation, a tougher regulatory environment, they're both seeing that, they're both seeing more stress, CFOs and human capital executives than the CEOs from that large 30,000-foot view. Mm. And on the human capital side, I mean, things like GDPR, which is starting to have and having an impact on internal data collection to fuel strategic workforce planning and data analytics on the human capital side, starting to put a squeeze and making it more difficult. So you can see that, from their viewpoint, that a tougher regulatory environment is having an impact on their day-to-day function. So I think that's an interesting point. And when we go to the cybersecurity notion, as Ilaria mentioned, I mean, last year it was #1 for U.S. CEOs. It's gone down the stress list a little bit. I think there's a lot more familiarity with the issues around cybersecurity. I think that the C-suite has educated itself to a point where it's a little more comfortable. It's a little less scary. They see some real acts to mitigate that kind of risk. So, even while out there, I mean, this notion of 70% of the CEOs that in our poll said that they were going to increase their cybersecurity budgets, right? But one of the issues that I think crops up is that this is the idea that if we throw money at it, it might go away. Mm-hmm. And when we look at the other responses in those cybersecurity questions, some of the most basic mitigation risk strategies, they're not fully on board with, right? So even having a clear strategy for the impact of a reputational or financial impact on a data breach, still there's 40% of the companies out there saying they don't really have a strategy. Yet they're willing to throw money at it. So that is, perhaps not a wise spending notion. I mean, to have those strategies in place, mm-hmm. have a board that asks the right questions is really important. And then that money that they intend to increase towards this year will be spent more wisely.
Okay.
And so, for climate change, I think is really an interesting notion. It's traditionally for the last 4 or 5 years that it's been included in our poll, it's been a bottom feeder, right? It has not been a concern for CEOs. But over this last year, we've seen it rise, right? It's in the top 10 now. Mm-hmm. That surprised us a little bit. And a lot of that's being driven by not only the consumer side, the demand for more transparency in how sustainable manufacturing, where do my products come from, mm-hmm. right? And what is the impact on the environment of those products, right? They're starting to feel that and see that pressure and can see it as a potential advantage on the consumer side, but it's also being driven by a lot of investor interest, mm-hmm. Demand for disclosure of climate risk and climate risk strategies, And that public reporting, we're seeing a real uptick in the research that we do on our governance side, a real uptick in the non-financial reporting, especially related to climate risk. And we think that pressure is going to be increased as well. CEOs see that as that pressure increasing. So that's that notion, the impact of climate change, finally coming out of the shadows, if you will. And obviously what's going on in Australia, for example, is having a devastating effect on the economy. So
do you expect this to trend higher in the years ahead as well? And how is it evolving in terms of on a geographic basis? Who's most concerned, who's least concerned, and how has that been evolving, and how do you expect it to maybe evolve over the next couple of years?
Yeah, I think that's a good point. I think, in the mature economies, we're starting to see a regulatory push for that disclosure, right? And an investor push. One of the odd data points in this survey was that notion of impact of climate change was last in China. One of the countries where that is having a real impact, not only on the population health and wellness, but also being driven by government regulation. It was much higher in previous years in China, but I think maybe if you look at it in its totality, that there are so many more emerging pressures on the Chinese economy now that the growth is not easy, that it's much more, it's earned, it's harder to gain. That when it comes to relative priorities, climate impact is nice to have, but there are so many more important we had to have. So I think that's part of the explanation for that.
That's really interesting. Thank you very much.
If I can add something to that, it's interesting that it's closer to my side of the world where it's ranking higher. So it's ranking higher for CEOs in Japan and Europe and also in Latin America. So I'll tell you the exact figure. So it's let me see that. Okay, so it's number 8 for CEOs in Europe, number 6 in Japan, and number 4 in Latin America. So it's these CEOs in these continents that are behind the fact that
that's interesting, Ilaria, because you could make the argument at the surface that maybe this is more of a developed economy concern, while emerging markets are more focused on climbing the rungs of the economic ladder. But that Latin America number, I think, really sort of destroys that kind of an argument that this is something that the West cares about and that nobody else does.
Right, and I think behind the push of investor that Chuck rightly mentioned, I think, well, of course, in Europe there is a stronger regulatory pressure, but on top of everything, I would put the consumer expectations, and we have very interesting data. We don't have a slide on that, but I will go from top of my head. According to our consumer confidence data, it has been the concern over climate change has been increasing a lot. So we have a question actually that says, what is your top concern among the following? And then there is a list of 20 things, and you can see that number 1 is very often either the economy or health or job security. These are the most popular answers worldwide. But if you look at the item there at the bottom of climate change, global warming, this has been increasing a lot. And there is countries like Germany and France where as many as 14–15% of consumers consider that their top concern. So I think at least in Europe, where I know the numbers a little bit better, there is a strong push, there is a strong expectations from consumers to take action on this.
Yeah, and there's another interesting point. I think when we asked about the collaboration side of it in this year's survey, one of the key drivers for CEOs globally for external collaboration with non-traditional partners was to improve their sustainability performance. And I think part of that is the compliance, the regulatory side, but as Ilaria mentioned, the other part of it is the new markets and growth side, right? Meeting those consumer demands. Although our research does show that consumers are not willing to pay a large premium for sustainably produced product, they're still willing to pay some premium. So there's the risk, and then there's the growth opportunity in meeting those demands. I think it's an interesting point.
Okay. Well, why don't we move ahead and maybe talk a little bit about the internal hot button issues and what you learned from the most recent survey.
Uh, I can take that too, real quick. So it's about talent. It's about talent issues, talent risk. It's about attraction and retention of talent, especially coinciding with the push from tight labor markets, right? How do you retain and evolve your existing workforce is really important as a development of new leaders, but also this whole notion of disruptive technologies forcing change, forcing new business models. It's been high on the list for the last couple of years, and the whole notion of digital transformation. A lot of organizations, a lot of our members see it as a top priority, but they're still struggling with the execution. But that is really an important part for them, and that kind of also goes along with the notion of creating a more innovative culture, right? So you have the intensifying competition. How do you deal with it? You get more innovative. Mm-hmm. But creating that culture is also a heavy lift for a lot of organizations.
And is there a lot of variation geographically on these topics, or?
There's different rank order. Mm-hmm. The talent concern is universal across across all geographies. I think it's interesting that China's a little bit more concerned about performance management and aligning compensation, right? So as the China economy is, again, that growth story becomes harder to achieve, you're looking for productivity boosts. Mm-hmm. And the wage inflation in those areas, the CEOs see that as a concern. Getting that under control is really important.
Mm-hmm. Anything to add, Ilaria?
Well, I think there is another interesting data point of the innovative culture. This is ranking number 3 globally, and I'm looking in Europe, where it's definitely perhaps a struggle. We are always the old continent at the end of the day, and so there is a concern there that companies should find a better way to foster a culture of innovation.
Yeah. And I guess just the question is, one of the disconnects that we've always seen in this is that the notion of wage inflation does not figure very highly as a stressor for CEOs when it comes to the internal side. And we know there's tight labor markets, right? We've seen the wage bill start to increase. And that's always the question that always comes to our mind is, when are they going to start to feel that squeeze? We know it's starting to squeeze profits, right? So, when does that wage concern or wage rise concern start to worry? And it just hasn't surfaced yet over the last couple of years, despite the tightening labor market. So, we just find that as a curiosity more than anything.
Yeah, I think it would depend a little bit on the kind of company question, right? I mean, the biggest wage inflation that we've been seeing in the U.S. has been more with those blue collar kinds of jobs.
Right.
So companies that are maybe not engaged in kinds of operations or businesses that are exposed to that aren't going to be feeling that heat as much as a manufacturer, for instance, might be. And in terms of function,
a data point.
Go ahead, Ilaria.
A data point that I find interesting here, and when we put together the list, we had a lot of curiosity on the result on that, is this item that you see in the second half of the list, which is redistribute work between humans and machines. And it seems not to be a concern. I mean, it's definitely below number 10, and it's quite, it's not really ranking high anywhere. So I'm a bit surprised there. I would have thought, it's something that is a huge societal discussion. You can always read about it often, and I'm surprised that it's not ranking higher than.
Well, maybe it's one of those issues that sort of like climate change is going to creep up on us once we realize that it's really a sort of on the foot of our door.
Right. But once the robots fill out the survey, I'm sure it'll be much higher. But.
They already are, Chuck. They already are.
But I think that yes, that's one of the issues that can kick down the road a little bit. We know that the artificial intelligence is starting to have an impact. Especially, we've done a lot of work on the human capital side in artificial intelligence. It's there, but it's not being maximized. It's not being utilized to its full potential at this point in time. A lot of it's aspirational. I think you're right. This may climb up the list in years to come.
It may. Ilaria, do you want to? We have a little bit of time here. Do you want to? Let's see here. There we go. Female C-suite executives. What did we learn about from the survey on this topic?
So this is, if you remember the list before, we didn't talk about it because it wasn't ranking high, but actually in the report we talk about it anyway because it should rank higher than it is. So currently is number 16 in the overall result among CEOs. But interesting thing is that it ranks much higher if we only look at female respondents. So that's number 6 among.
What share of the respondents were actually female versus male? I mean, I'm just wondering.
It's a little bit more than 20% among CEOs, and it's a little bit higher. I think it's 35% if we look at the entire sample of C-suite executives.
So it's substantial.
Yes, it's not a small percentage, but really my first thought when I saw the result was like, okay, but it will take a long time to address the issue if we just wait for having a 50-50% share between male and female CEOs. So I think, yes, this is something that should definitely rank higher, and I think the economics are on the side of solving the issue in the sense that a tight labor market perhaps puts some pressure on companies to address this item when you're competing for talent in such a fearful way like we see now, especially in Japan and US, for example. Maybe companies will have to address this more urgently.
No, I know, for instance, in Japan, you know, the mobilization of the female population and bringing them into the workforce has been a strategy in terms of trying to get around some of the demographic challenges that they've been facing in terms of a limited workforce size. So perhaps, you know, in Japan at least, we may see this start to creep up at a faster rate as well.
Yeah, I mean, I think there's a difference between engaging the females, those that have left the workforce and are trying to come back in, and then paying them for equal pay for equal work, right? And you know, I think that there's a focus on bringing females back into the workforce. Now, part B is making sure that there's pay equity there too, right? And you know, I think a lot of organizations are committed to the first part because of the tight labor markets and the need for talent and skill, but the pay part is lagging, right? And that's a concern. It was even which surprised us a lot. I think it was pretty lowly ranked too on human capital executives' agenda. And that I found a little disturbing too.
So a part of my job as an economist is to make forecasts about what's going to happen in the coming year. And so the two of you are heavily involved in the survey and the data and the analysis. What are the top 1 to 2 issues that you think CEOs are going to care about a year from now? Is it going to change a lot? Are there anything on the horizon that you think is really going to keep them up at night over the next 12 months?
You know, for me, I mean, a lot will depend on maybe black swans, right? Who knows, right? Yeah. What's going to happen next, right? In that sense, whether it has an impact on energy prices or, but you know, I think that I would think that cybersecurity too may start to be a little bit more of a resurface again as a concern. I think maybe this notion around wage inflation will start to surface, move up the ladder a little bit, and you know, hopefully the fear of recession or recession risk starts to recede again.
That's what we think.
That's what we would. That would be good. And of course, if that starts to happen, I mean, the impact throughout the organization and the macroeconomies, people starting to spend again, like the proverbial drunken sailor, right? I mean, that would be great for everybody.
What about you, Ilaria? Any projections?
I will only answer if you promise to me that in a year from now you will not.
That's not fair. Like, people quote my forecast a year in the past and hold me to task. So of course I'm gonna do that to you.
All right. Okay. Let me give it a try. No, I think one thing that will stay there for a while is the concern about trade, and even though we expect the trade tensions to abate, or between US and China, we've been observing over a longer period of time a sort of increasing in protectionism in very strange forms. I mean, not only tariffs, but for example, help to national companies, like favor the national champions and things like this. So I have the feeling that trade will be a concern for a long time, especially in this phase where we're going perhaps through a new wave, different form of globalization compared to what we've been living in until a couple of years ago. So this will be one. The other one is climate change. I think it will continue. I mean, if you look at, there is much more attention from the media also to the connection between certain events and climate change, like we're seeing in Australia right now. I'm sure this will continue, and this will push consumers on the one side and on the other side companies as well to be more careful about it.
Okay. Well, thank you both very much for entertaining my my question. So yeah, a great report. Is it now available on our website? Has it been released formally yet?
It is indeed, yeah, it was a few days ago, so it is indeed up on the Conference Board website.
Great. Well, make sure to the audience to go take a look. You can dig into the numbers a little bit more deeply, and I'm sure Chuck and Ilaria will be happy to answer any questions that you have on that. So this is the conclusion of our webcast for this month. Again, the Economy Watch, which is the new name, it's not Economic Watch anymore, it's Economy Watch, takes place on the second Wednesday of every month. We also have a number of videos that we release quarterly, just snippets on what we think about the U.S. economy, what we think about the European economy. Make sure to have a look at those as well. And then, of course, there's all the indicators that we publish consistently throughout the month that you should try to keep an eye on, at least for the economies that are most important for you. As I mentioned, next month we're going to be tackling the U.S. housing market, which I actually find to be really interesting. I'm going to be joined by Ottoman, one of our senior economists here, as well as I'm sure we'll be able to find a guest speaker or two to come in and talk to us as well. So that's something to look forward to. Make sure to put that on your calendar, February the 12th. I also want to plug quickly the podcast that we do on the economics team here called Indications. It's available on our website. We tackle all sorts of interesting topics that you can delve into, and that our members generally find to be quite important. And then finally, we always welcome your feedback. Please let us know how we're doing, how we can improve, and we will see you next month. Thanks so much, and have a good day.